Good afternoon, everybody. My name's Kim Reynolds, and I'm a director here at Vincent in the tax advisory team. So I'm here today to provide you with a bit of an update on last night's federal budget. Sorry for the late start. I had some technical difficulties. So just before we start, just an important message that a lot of the information that we're talking about today will be general in nature. The nature of a federal budget is a lot of the information that's provided is general, so the detail will come at a later date. But if there are any particular issues that we talk about today that you want further information on, feel free to reach out either to myself or to your Vincent's advisor, and we will try and assist you as best we can. So as I said, my name's Kim Reynolds. My contact details are there on the slide if you want to get in touch. And I guess just before we proceed on looking at the specifics of what was announced last night, just some context of the budget overall. We've got a new government, and as such, this was their first budget and the first Labor budget that we've seen in about 10 years. It was delivered with a backdrop of what are generally considered to be some challenging economic conditions. We're emerging from the pandemic, both here and around the world. We've got increasing energy prices. There are cost of living pressures that I think that we're all seeing, and we've got an environment of rising inflation. Just this morning, it was announced that our inflation level had risen to 7.3%. and which is the highest that Australia's had since 1990. Now, the Treasurer last night said that the forecast was for inflation to increase to about 7.75%, probably later this year, but gradually then reducing over the next couple of years to about 3.5%, I think he said, in the 23-24 financial year. So with that background, there was a lot of things to balance up, I guess, as far as the new government was concerned. And it's unusual for us to have a budget in October, but because we've got the new government and with those challenges that I've just mentioned, both here and overseas, waiting until May next year to deliver a budget was really not realistic. So the government concentrated last night on a 5-point plan for cost of living relief, really. So focusing on things like childcare, paid parental leave, expanding that plan, medicines, housing, and also trying to get wages moving, which is going to be a bit of a challenge over the next little while. I think it's going to be the laggard in all of these things. So with those 5 things in mind, tax changes weren't really front of mind for the government. And although there was mention of budget repair work that needed to be done, in last night's budget, it seemed to be more focused on tax integrity measures that I'll talk about a little bit later. Having said that, there were some tax announcements that were made, but probably not significant ones that are going to take a lot of time to digest. So the first area I want to talk about is in relation to personal taxation. So there are no personal tax rate changes announced last night, and the stage 3 tax changes that are to commence on the 1st of July 2024 have already been legislated. So they're all sitting there waiting to go on the 1st of July 2024. There has been talk in recent weeks, and I'm sure that talk will continue at least until the next budget, and probably until July 24 when the changes commence, as to whether those tax changes are affordable, whether they should be introduced or scrapped or partially just pared back. But just in summary, tax rates for individuals for this current financial year, 2023 financial year, and 2024 will remain the same. But from 1 July 2024, the middle band of tax rates will disappear. So the 32.5% and the 37% bands will disappear. And the top marginal tax rate of 45% will kick in at $200,000 rather than $180,000. So there are a few little changes that are going to happen there. and which will, we'll wait and see as to how they get implemented in a couple of years' time. I think we've seen in recent years that a few months is a long time. So what can happen between now and 2024 is anybody's guess in the tax space. One of the things that will impact personal taxpayers in this financial year is that there's been no extension of the low and middle income tax offset for the 2022-23 income year. So it was $1,500 in the 22 year. Prior to that, it was $1,080, but that's now been cut off, so we no longer have that. But the low income tax offset will continue. There are no changes to that, and with the maximum offset being $700, which is phased out over depending on what your taxable income is, but it phases out entirely the taxable income of $66,668. So that was basically it as far as the personal tax situation is concerned. There was really nothing else from a personal taxation announcements last night. As far as the business taxation side of things is concerned, there were some announcements that will impact on particularly larger businesses, and some clarification of whether certain proposed changes that have been previously announced, whether they would proceed or not, or what dates they might proceed on. So just touching on some of the business taxation measures that were announced. In relation to thin capitalisation, and that really affects businesses that are looking to claim debt deductions and have to consider what their ratio of debt to equity might be as to whether they can satisfy certain tests that can result, if they fail, in the denial of certain debt deductions. So it relates to debt deductions that are more than $2 million in a year. The rules are particularly complex, so more detail is required, but just in summary, for those that may be impacted by them, we currently have 3 tests that we need to consider when we're looking at thin capitalisation: the safe harbour test, the worldwide gearing test, and also the arm's length test. Now, the proposal put forward last night is that the safe harbour and the worldwide gearing test would both be replaced by a new earnings-based test for limiting deductions in line with the entity's profits. And the proposal is that the entity's debt-related deductions would be limited to 30% of profits, and those profits being measured by EBITDA. The deductions would be denied would then be able to be carried forward to later years, up to 15 years. And an entity in a group that might be able to claim debt deductions up to the level of their worldwide group's net interest expenses as a share of earnings, and that might exceed, based on the proposal, the 30% EBITDA ratio. Now, although the arm's length test is going to be retained, it's going to be more used as a substitute test, and it'll only apply to an entity's external third-party debt, so essentially disallowing deductions for related party debt, which will require a rethink of for some organisations where they are funding debt internally, and as to whether they need to rejig how the funding arrangements might work to be able to satisfy the proposed new rules. Now, these are proposed to change from the 1st of July 2023, but as I said, the rules are particularly complex, so it's important that we understand what the detail is in order to be ready for 1 July 23. A couple of other measures that were announced last night in relation to intangible asset depreciation. There was a proposal announced previously about self-assessment of intangible asset depreciation. The government has decided not to proceed with that, and what that means is that the effective life of an intangible asset will continue to be set by statute. For off-market share buybacks, a change in relation to how those are undertaken by listed public companies. This is more an integrity measure. And essentially what it means is that the treatment of off-market share buybacks that are undertaken by listed publics will be consistent with the treatment of on-market buybacks. There are more details to come, and again, another complex area of legislation, so the details will be very important. Important to note, though, that the date of effect for those changes will be as of 7:30 daylight time last night. Now, as I mentioned at the start, there are there are not a lot of tax measures, new tax measures announced, but there was some discussion about some of the previously announced measures and what would be happening with those. Now, there are a few of the previously announced measures that the government has decided to abandon. One of those is some changes to the debt equity rules that were first mooted back in the 2013-14 income year. So we've been waiting for quite a while for those, but the government's decided to abandon those. Changes to the taxation of financial arrangements rules, that again was mooted in 2016-17, has been abandoned. Changes in relation to asset-backed financing arrangements, also abandoned, and introducing a framework for limited partnership collective investment vehicles also has been abandoned. Now, there was a proposal to change the annual audit requirements for self-managed superannuation funds, and this was announced in the 2018-19 budget. The government has decided that they will abandon those proposed changes, and that was, if you recall, that was related to requiring self-managed super funds to have a 3-year audit cycle. And then lastly, there was a proposal for providing a limit of $10,000 for cash payments that are made to businesses for goods and services, and that has also been abandoned. I did wonder at the time when that was announced as to how they would really manage to monitor that and really administer it, but I think they've probably seen that it's going to be quite difficult, and as such have abandoned that plan. There were, however, some previously announced measures that haven't been abandoned, but the start date has been deferred. And these really relate to measures that were supposed to start on the 1st of July 2022. And I guess with the changeover of government, it was probably difficult for the new government to properly legislate these changes in time for them to really commence, to be able to commence on the 1st of July. So they've been pushed back a little bit. Now, those relate to some taxation of financial arrangements technical amendments, so they're going to be pushed back until the year starting on or after the date of royal assent of the legislation. There have also been some proposed changes to the self-managed super fund residency requirements, so a relaxation of those residency requirements that was supposed to start on the 1st of July 22, but again deferred until an income year that starts on or after when royal assent is given. Those residency requirements that were being relaxed really related to increasing the safe harbour period from 2 years to 5 years, and also removing the active member test in respect of self-managed super funds. Now, last year there was also an announcement by the government to introduce what's referred to as third-party reporting rules, and they relate to businesses that provide electronic booking platforms, essentially. It was proposed that transactions that related to ride sourcing or short-term accommodation were going to need to start reporting information to the ATO from 1st of July 2022. That's been pushed back until the 1st of July next year. And all other reportable transactions, so transactions relating to, again, electronic booking platforms that service asset sharing, food delivery, or tasking-based services, will be pushed back to 1 July 2024. Okay. So there's been an increased focus in recent years on tax transparency, particularly in the context of large global organisations. Every country wants to ensure that companies are paying the right amount of tax, or what's considered to be the right amount of tax, in each jurisdiction, and individuals, society generally is looking for a bit more transparency as to how, what tax is paid and where it's paid. So in that context, and also an increased focus on just governance generally, and tax governance particularly. And last night there was an announcement that significant global entities, and these are entities that have got an annual global income of in excess of $1 billion, they need to prepare tax information on a country-by-country basis and provide a statement as to their approach to taxation in each of those countries. And that information needs to be disclosed to the ATO. Also, Australian public companies, and they can be listed companies or unlisted companies, will need to disclose information on the number of subsidiaries that they have and the country of tax domicile of each of those subsidiaries. Looking at tax domicile, and going back to my point earlier about countries being concerned about where taxes are being paid and making sure everyone gets their fair share. Where a company or a business, tenders for an Australian government contract from the 1st of July 2023, and that contract is in excess of $200,000, then the tenderer must disclose the country of domicile, so that the government can clearly understand where it's obtaining its services from and where the tax dollars might be going. Now, just finally, in relation to business taxation, there's been an increased focus and more attention being given to digital currencies in recent years, as more and more people interact with digital currencies, and governments are having to scramble essentially to work out how they're going to deal with them from a tax perspective. And the tax system is always a bit slow to catch up with what's happening commercially. But during the year, the government has discussed and provided draft legislation on how to treat digital currencies from an Australian tax perspective, and determined that digital currencies from an Australian perspective won't be treated as foreign currency. So this includes digital currencies like Bitcoin. So they'll continue to be excluded from the income tax treatment that Australia has for foreign currencies. So we'll maintain the current tax treatment of digital currencies, including the CGT treatment applying to them when they're held as an investment. So this won't apply in situations where digital currencies are issued by or under the authority of a government agency, and they'll continue to be taxed as foreign currencies. So I think this is a space that will continue to evolve relatively quickly, because I think commercially it's moving a lot more quickly than what the tax system is. But it's an important area to keep your eye on and make sure you understand how it works, and the information that's flowing around, that basically from clients, individuals themselves, and the information that they're providing to us as tax agent. Also understanding what information the tax office might have access to be able to understand that there is information there that needs to be disclosed to the ATO and may need to be included in tax returns. And the last point I just wanted to raise here was in relation to COVID payments. As we're all aware, there have been quite a number of COVID payments provided by the federal government and also state and local governments over the past couple of years, 3 years. And in general, those payments have been non-assessable, non-exempt for income tax purposes. But due to the vast number of those payments that were being made, along the way there were some that appeared to slip through the cracks, I think, and weren't granted that non-assessable, non-exempt status. And so the government is broadening those on the list that will be given non-assessable, non-exempt income status. And for those of you that are online, that are you can download a copy of our budget summary today, and there is a list of those payments that have been added to the list of non-assessable, non-exempt payments. Now, in relation to superannuation, I don't normally talk about the superannuation side of things because one of my colleagues, Brett Griffiths, is normally doing these updates with me. However, he's on holidays in Europe at the moment, the lucky fella. So I'll get to talk about a couple of the superannuation areas. So thankfully, there's only a couple of them. The main, I guess, change or announcement was in relation to the superannuation downsizer contributions. This has been previously announced, and actually there's a bill sitting in Parliament at the moment in relation to it. So what this change relates to is changing the minimum eligibility age for contributions in relation to downsizer. So downsizing your home from selling your main residence, essentially. So the age is going to be lowered from age 60 to 55. So it'll allow individuals that are age 55 and over to make an additional non-concessional contribution up to $300,000 per contributor from the proceeds of selling their main residence. And those contributions will be outside the existing contribution caps. So either the individual or their spouse must have owned the home for at least 10 years, and the contribution has to be made within 90 days of the ownership change, so essentially within 90 days of settlement. So it's something definitely to keep in mind if you're thinking of selling your home. It's something to definitely talk to the super team about as to how you might be able to access those downsizer contribution rules, because it does allow you to actually put a little bit more into super, and then you can use it within the superannuation environment going forward. So, as I mentioned, that legislation is currently in Parliament at the moment. Now, just I guess in the same sort of context, to encourage people to downsize, for those that are impacted by having to look at the Social Security Assets Test, then there's an extension of the Social Security Asset Test exemption for principal home sale proceeds, and that's been extended from 12 months to 2 years. So essentially what's going to happen is that there's a change of the income test to apply a lower deeming rate of 0.25% to those proceeds, and that will be used to calculate the deemed income for 2 years after the sale. Again, this legislation is already sitting in Parliament, and so we're just waiting for it to proceed through the House and the Senate. Now, I mentioned at the start that really the tax measures that we saw introduced last night were in the context of tax integrity and trying to the budget repair, looking at the tax integrity measures as opposed to providing additional tax for particular individuals like we've seen in the past. So part of that process is that I think, as we've seen in quite a few years in recent years particularly, an increase in funding for the ATO to increase their compliance programs. The personal income tax compliance program has been going for a little while now, and that has been extended for another 2 years from the 1st of July 23. So there's an additional $80 million that's been given to the tax office to expand that program or extend that program. That program mainly looks at the overclaiming of deductions, and incorrect reporting of income. It will also look at modernising guidance products, so particularly aimed at individual and personal tax, where a lot of people might go to the ATO website to find out information. Some of those guidance products do need a little bit of updating, so some of the funds will be used for that. It'll also, however, be used by the ATO to allow them to engage earlier with taxpayers and tax agents. So although we're in a self-assessment system, and I guess we're used to the fact that we lodge a tax return and the ATO may come back and ask us a question about that return at some point in the future, and then we talk to them about why we've claimed a certain thing or not, and how that should be dealt with. The tax office does seem to be moving more towards this early engagement type process across all levels of taxpayers. So this enables them to start doing that, particularly where they see certain transactions or taxpayers that are in a particular industry and the like, where they can engage earlier to ensure that what they consider to be the correct approach is adopted in returns before they're lodged, as opposed to them having to look at it after it's been lodged. There will, of course, be targeted compliance activity. The ATO's information and data collection process now is quite sophisticated, and they can identify particular areas of the market and where they need to devote resources. So there'll be ongoing targeted compliance activity, and I think we're all seeing a little bit more of that now that we're emerging out of the pandemic, that there is a bit more of a focus by the ATO in trying to understand why particular transactions have happened, and a bit more audit and review activity going on. There is an estimated increase in receipts of about $670 million and payments of $80 million over the next 4 years. So watch this space. On top of that, there's been a shadow economy program, so looking at the black economy and cash payments, etc. It's been going on for quite a while. It's been extended for another 3 years. And it's estimated to increase receipts by about $2 billion over the next 4 years. So there's, I remember when GST came in, that the thinking was that this would get rid of the cash economy, and we would not have to worry about it anymore. And it turns out that here we are 20 odd years later, and we still think that there's a gap. So there'll be a bit more activity in that for a few years to come. And of course, there's the tax avoidance task force. That's been in play for a number of years as well. It's getting increased funding of about $200 million a year for the next 4 years. And it will look at particular priority areas where it's seeing, again, using the ATO's data gathering material, that they can, they're observing particular business tax risks, and will be looking at review activity and audit activity in respect of those particular tax risks that they see. There is an ongoing focus on multinational and large public and private businesses. There's been a top 500, a top 5,000 review process been going on for quite a number of years now, and those that are in that space are regularly having to deal with the ATO in respect of the ATO trying to understand what their tax position is and their approach to dealing with tax. That's not going away anytime soon. And there'll be an increase, an expected increase in receipts by the ATO of about $2.8 billion and payments of about 1.1 over the next 4 years. And the last item there in relation to modernising business registers, this seems to be a standing item in federal budgets each year now, where we've got a number of online business registers of various sources or sorts, and there are funds being put aside to allow the government to modernise those business registers. So this year the focus is really on consolidating about 30 business registers with the ATO and ASIC to make them easier to use and I guess more meaningful as far as the users are concerned. Again, in relation to tax integrity, part of the whole process of ensuring that the tax system maintains its integrity is the involvement of tax agents. And there's going to be an increase in funding for compliance investigations being undertaken by the Tax Practitioners Board to ensure that high-risk practitioners and also unregistered preparers are identified and investigated appropriately. And there are what's referred to as new risk engines that are going to be used to identify those who engage in poor and unlawful tax advice. So really just matching behaviours, the types of returns or claims that might be made in tax returns that are lodged by particular tax agents, particular types of arrangements that are entered into as for structuring, etc. Then they will be looking at or able to look more easily at identifying whether particular tax agents are involved in those particular arrangements. So there'll be a bit more focus on tax agents themselves as well. And the purpose, as I said before, is really just to improve tax compliance along the way, but also raise the industry standards for all of us. Now, as I mentioned at the start, there's not a lot in the tax space for this budget. So I've spoken about the main issues that were discussed last night. The other measures that were non-tax related really focused on housing measures. So we've got a housing crisis around the country that we've heard about regularly in recent times. So there are three main focuses that were talked about last night. The Regional First Home Buyers Guarantee Scheme, which is really encouraging people that are moving to the regions by allowing them to have a much smaller deposit to put down on their home. The Housing Australia Future Fund, which is a proposal for a $10 billion fund to invest in more social and affordable housing around the country. And also a new housing accord that's been endorsed by superannuation funds, where the government's going to contribute $350 million over the next 5 years with the goal of creating, I think it's about 1 million new homes around the country. So that's a fairly big task to do. And but in the hope that we can deal with the housing crisis that we're currently seeing. The other measure that was discussed last night and was also had been previously announced in, I think, the government testing the water to see how it was going to be received. The paid parental leave measures are going to be expanded so that either parent can claim the payments, and that applies to birth and non-birth parents, where the ability to claim the weeks of the payment can be taken concurrently, so parents can have the time off together to enjoy with their new child. And from the 1st of July 2024, there'll be 2 additional weeks per year added to the paid parental leave scheme until it reaches 26 weeks, which will be in the 26-27 financial year. The family income test will also be, the threshold for that will be $350,000. Now, those paid parental leave changes will take effect from the 1st of July next year. And finally, the other measure that was discussed last night was in relation to childcare. The childcare measures announced were an increase in the maximum childcare subsidy rate from 85% to 90% for families with a first child in care, and also maintaining the current higher childcare subsidy rates for families that have got multiple children that are under 5 in childcare, and that ceases 26 weeks after the older child's last session of care or when they're 6 years old. So again, that starts on the 1st of July next year. So that's about it from as far as the update's concerned for the budget last night. Not a lot there from a tax perspective, as I said. The focus really was on looking at cost of living pressures. There's been a lot of discussion in the last 12, 18 hours or so about whether it's been they've gone far enough and whether they've made changes in the right areas. But I guess we'll wait and see. It's the current economic environment is pretty fluid, so I imagine it's pretty hard to balance up. The Treasurer did comment last night that there are some challenging times ahead, so it'll be interesting to see how things go over the next few months and how the next budget in May 2023 really shapes up. So I'd just like to thank you all for coming along today, and if you've got any questions, as I said, please reach out to either myself or your Vincent's advisor. But otherwise, have a great afternoon. Thanks very much. Bye.